Albert Einstein wrote this quote and posted it on the wall of his office. With the Fed meeting minutes being released this week and even being slightly dovish, investors are still counting on a rise in interest rates. In this week's video, we'll look at whether stocks and rates can rise together, what sectors benefit from rising rates, and of course, we'll wrap up with a look at the week ahead in the markets. There are three main causes of recessions. The first is a surge in oil prices. Oil prices are certainly going up, but they're coming off an 18-year low of $28 a barrel, and at $72, prices are nowhere near the high of $141 that was reached at the peak in 2008. In addition to supply concerns, oil prices are reflecting demand from increasing economic strength. Oil doesn't look likely at the moment to cause a recession. The second is an unsustainable credit expansion tied to a bubble. We had the tech bubble in 2000 and the housing bubble in 2007. Credit is debt. Most financial crises are a result of debt that can't be repaid. As we've reviewed in previous videos, we would see deterioration in the market before significant losses like those associated with the bubbles in 2000 and 2008. The charts we have today show that the long-term trend is still intact. That brings us to rising rates, which is the current concern of investors. Rising rates can cause yield curve inversions and can make bonds more attractive than stocks. We invest based on the evidence on the charts today, and as of now, the curve is not inverted, and investors still clearly prefer stocks over bonds. Nevertheless, rising rates are an important consideration. So let's look at how and when rising rates matter. Rising rates have implications for stock valuations. During the expansionary phase of the business cycle, increasing earnings, as we looked at last week, can offset rising rates. Late in the business cycle, rising rates can make bond yields more attractive than stocks. In a relative strength comparison of the S&P index to the 10-year bond index, investors still have a clear preference for stocks. As mentioned in the previous slide, the yield curve is not inverted. The Federal Reserve's meeting minutes released on Wednesday of this week show that the Fed is very aware of the potential to invert the curve and will be careful not to do so. So why are investors concerned about rising rates? This is a monthly chart of the U.S. Treasury 10-year yield from 1978 to 2018. This is a very important interest rate. As you can see, since 1981, we've been used to a deflationary environment with falling rates. Every significant increase in rates precipitated a crisis. With the 1987 crash, the 1990 savings and loan crisis, the 1994 bond rout, the 2000 dot-com bust, the 2007 housing bust, and the 2013 taper tantrum. If you've only been investing during this period, or you don't know your market history, it's understandable that you would associate rising rates with declines in the stock market. If this is all that you know, it would be especially frightening to see rates rise above this downward trend line that's been in place for 38 years. You can also see that rates just cleared the level of the 2013 taper tantrum here earlier this week before slipping back below. Obviously, we're testing this line. But going back to our opening quote about what counts, maybe investors are only counting half the relationship between rates and stocks. If you've been watching our videos, you'll recognize this chart. Going back to 1927, the market has been through several major cycles of sideways consolidation in yellow, followed by long uptrends in green. In the upper right-hand side of the chart, you notice that in 2013, we emerged from another long sideways period of consolidation that included the tech bubble and the housing crisis. And once again, we're in an uptrend. If we drop in our rate chart from the previous slide, we see that rates declined from 1981 to present, and during that same time period, stocks went up. It's a fair question to ask, what did rates do in this period from 1953 to 1981 when stocks also rose? This set of charts goes back to 1871. The upper pane shows the S&P and the lower pane shows the government long bond yield, which later became the 10-year U.S. Treasury note yield. On the chart of the S&P, you see our three familiar periods of sideways consolidation, and on the lower chart, you see interest rates or the yield on the 10-year Treasury note. When rates are rising, we're in a long-run inflationary environment, as you see here. When rates are falling, as they have from 1981 to present, we're in a long-run deflationary environment. Rates are making a higher high, signaling a regime change back to an inflationary environment. If you follow the dotted line back to the arrow, you see that rates were at this same level in April of 1955 when the market was rising. Stocks and rates rose together from 1953 to 1981. This answers the question about whether stocks and rates can rise together. This quote will guide us as we look at what sectors perform well in a rising rate environment. Remember, these are observations about the business cycle and sector correlation with rising interest rates. These are not investment recommendations. This chart will show ETFs by sector and how they perform with rising rates. The ETF's ticker symbol and description will be displayed on the left-hand side of the chart, with growth sectors listed at the top and defensive sectors listed at the bottom. In an inflationary growth environment with rising rates, fixed future cash flows such as dividends from defensive stocks can become less attractive relative to risk-free treasuries. Rising rates adversely impact bonds, high dividend stocks, and bond proxies. So what sectors do well in a rising rate environment? Sectors with high growth to offset rate increases do well. These include high beta stocks that tend to be growth stocks. Banks do well, and the regionals are poised to benefit from a combination of more profitable lending spreads, growth-driven loan demand, and deregulation. Materials, which benefit from inflation. Energy, which along with several of the next sectors we discussed in last week's video. Industrials, financials, which include the bigger banks, and technology. There isn't room for all the sectors that benefit. Many of those not shown on this chart, such as consumer discretionary, were mentioned in last week's video, which you can watch if you missed it. The sectors that underperform are low-growth value stocks and other sectors that are similar to bonds in terms of dividend payouts. These include telecom, S&P low volatility, utilities, real estate, consumer staples, and broadly speaking, biotechnology, which includes large, lower-growth, high-dividend pharmaceutical companies in this particular ETF. This chart shows sector performance across the top relative to the business cycle represented by the orange line in the middle of the chart and the financial cycle in blue. The phases of the business and financial cycles are listed across the bottom. We'll use actual year-to-date sector performance to determine where we are in the cycle. The strongest performing sectors in descending order are energy, basic industries, cyclicals, services, and technology, although performance in technology has been somewhat distorted by the recent correction. Financials have long suffered from central bank rate repression, regulation, and recently from the rotation after a very strong post-election performance. But financials have a high probability of delivering strong performance with rising rates. Industrials are suffering as a result of unresolved trade issues. Utilities and staples are bond-like and are performing as expected in a rising rate environment. You can clearly see where we are in the business and financial cycle by looking at the cluster of the strongest performing sectors on the upper left. We're approximately here, and you can follow the dotted line down for the intersection with the business cycle. The Princeton business cycle is 8.6 years long, which suggests that there are several years left in the expansion. There will always be ups and downs, but as Jim O'Shaughnessy said, corrections are a feature and not a bug. The key to growing your portfolio is the ability to discern corrections from tops, which is why it's important to have a disciplined, model-based approach. This is an hourly chart of the S&P for this week. We usually don't cover charts on this small of a scale, but we're making 2 points here. The first is about paying attention to the longer-term trend and how easy it is to make emotional investing decisions based on headlines that appear to move the market. Let's take a look at some of the headlines from this week. We had Mnuchin's announcement that the trade war would be on hold, which lifted the market up over the prior week. We had Trump's announcement that the North Korean summit would be delayed, which brought the market down. The Fed meeting minutes were very dovish on Wednesday, which lifted the market up, only to take a leg down on Thursday on news of Trump pulling out of the North Korean summit meeting. The headline this Friday was about OPEC lifting supply restrictions, which did impact the energy sector and the performance that was mentioned earlier in the video. Despite all these headlines, if you step back as of 2:30 here on Friday, the market will likely close up a few tenths of a percent. For the week, the broader market is basically range-bound with very little movement in the grand scheme of things. On the daily chart, you can see the symmetrical triangle pattern that we've traded in since the correction. You could redraw the upper line to connect the most recent peak, but we did break out over this line, retest it, and now we're in a trading range. The 61.8% Fibonacci retracement is overhead, and the February monthly close is underneath. Earnings have wound down, and with Memorial Day, we're about to enter low-volume summer trading. Looking at our chart with the inverted triangle for the week ahead, you can see that price has been trading inside of the dashed green line and the dashed red line, which form an inverted triangle. Price has been trading inside of this triangle with an overhead resistance line and a support zone below, creating a trading range. Looking at the weekly chart with our triangle pattern Friday before Memorial Day weekend, you can see that all of the moving averages are rising and have good spacing between them. This is how we can visually see that the long-term trend is still up. We just emerged from a long period of consolidation from 2014 through 2016 and have been in a rising channel formed by a lower green line and bounded by this upper red line. And recently, this dashed red line has served as a source of resistance. Another significant area of resistance on the weekly chart lies overhead in the 273 to 275 area. The long-term trend is up. 2017 and the start of 2018 saw very strong advances, and markets often need to correct through time and price before the uptrend resumes. Remember, to be successful in a long-term trend-following strategy and to outperform buy and hold, we need to buy when the trend is confirmed and sell when a top is confirmed. This strategy offers the potential to capture between 80 and 90% of the trend. The key to success is a model that distinguishes market tops from corrections. You've seen that patterns and trends repeat in the market. Long sideways periods of consolidation are followed by long uptrends that are punctuated with interim corrections. To capture these types of returns, we can't trade on the worry of the day or financial headlines. If you look at the upper right-hand corner of the chart, a model helps us avoid being knocked out of the long-term trend by periods like this, that appear as a small blip in the overall scheme of things. Knowing the difference is what allows us to participate in substantial gains. Next week, the market will give us more evidence that we'll incorporate into our model. Based on the facts and model scores, we'll remain appropriately invested for the most probable outcome. And if and when the facts change, we'll change accordingly. The information in this video cannot address the specific investment objectives, financial situation, or particular needs of any viewer. The information presented is solely for informational purposes and is not a solicitation or offer to buy or sell any security or financial instrument. None of the information in this video should be taken as investment advice. Any opinions expressed in this video are subject to change without notice. Caliber Capital Management, LLC, or KCM, is not under any obligation to update or keep the information contained in this video current. KCM, its officers, employees, or clients may have an interest in the securities, related securities, or derivatives of the securities referred to in this video. KCM accepts no liability whatsoever from any loss or damage of any kind arising out of the use of all or any part of this material. KCM recommends that you consult with a licensed and qualified professional before undertaking any investment decision.